Good evening, ladies and gentlemen, and welcome to the Center for International Governance Innovation, or CIGI as we say. My name is Fred Kuntz. I'm the Vice President of Public Affairs here at CIGI. I'd like to thank CIGI's public events sponsor, Wordsworth Books, for its ongoing support in making our public events a success. Besides the audience here tonight, we also have a global audience watching on the live webcast. And following this evening's address, we welcome questions from the audience, either at the microphones here at CIGI, or if you're watching online, you can ask questions through the live chat function on your screen, and we'll transmit those questions to our guests on stage. A reminder to please turn your cell phones off. During last night's excellent lecture, 3 actually went off. This evening, we discuss currency wars and reform of the international monetary system. Our featured speaker this evening, Fred Bergsten, is a renowned and prolific expert on global economic issues, and after his remarks, we also welcome some comments from special guest Michael Horgan, Deputy Minister at the Department of Finance in the Government of Canada. Both guests will now be more properly introduced by Dr. Rohinton Medhora, who is President of CIGI, and will also help to moderate the discussion and your questions afterwards. Just a word about Rohinton. He joined CIGI last year after having served on our International Board of Governors since 2009. He's a former Vice President of Programs at the International Development Research Centre, which he joined in 1992 from the Faculty of Economics at the University of Toronto. His fields of expertise are monetary and trade policy, aid effectiveness, and international economic relations. He's published extensively on these issues. Please welcome Rohinton Medhora.
Thank you, Fred, and good evening, everyone. Thanks for coming out on this beautiful fall evening for what should be an interesting talk and discussion with you all on the question of currency wars and global monetary reform. To motivate the discussion and to introduce our key speaker, I would say that think tanks occupy a particularly interesting and sometimes precarious space, because not only do they have to produce good, solid, credible research, many people do that, but then also move that into the realm of public policy discussion and influence and outcomes. And our guest speaker, Fred Bergsten, through his stewardship and in fact creation of the then Institute for International Economics, now the Peterson Institute for International Economics, has been doing that for a number of years, between 1981 and 2012, during his stewardship of the Institute. It really set the tone for how think tanks can do good, solid work and be influential at the same time. And it's interesting how many of the issues that resonate even today, how do currency blocks interact with each other? What might be the connections between trade and finance, both theoretically and then also practically? How do we assess the emergence of Asia? Are issues that Fred and his group were working on decades before they joined the mainstream, and issues on which everyone now works. Before, during, and since his stewardship of the Institute, Fred has held just about every important economic policy and economic diplomacy portfolio in the US government. And despite that, he has been honored by a number of foreign governments, including the governments of France, Sweden, China, and I know I'm missing one or two because I'm very bad at reading notes, but Fred can remind us. I thought I got them all. There was one more that caught my eye. What was it, Fred? France, yes, right you are. Couple other things. He is the most cited think tank economist for over a decade and a half, and he was ranked 37 among the top 50 who really moves the markets list that the Fidelity investment folks did. And USA Today named him one of the 10 people who can change your life. He began his career in the late 1960s and early 1970s in US foreign economic policy in the White House as Assistant for International Economic Affairs to Dr. Henry Kissinger at the National Security Council, among several other positions that he has occupied. We will be joined in the discussion by Michael Horgan. Canada's eminent civil servant, now, as Fred said, the Deputy Minister for Finance. But Michael, in fact, has, having graduated from Queen's and Princeton universities, has occupied important positions in several economics-oriented portfolios in regional development, in energy, in the environment, in Indian and Northern affairs, and has also represented Canada and its constituency at the International Monetary Fund in Washington. So who better to help us think through these issues of currency manipulation and currency wars than Fred Bergsten and Michael Horgan. The way this will work is Fred will speak to us. We will then hear from Michael. We'll then have a bit of an exchange among ourselves and open the floor to all of you and, of course, our viewers on the web as well. So Fred, welcome to CIGI.
Rohinton, thank you very much for the very kind introduction and for some things you did not say. Sometimes when people introduce me as having been the economic deputy to Henry Kissinger, they go on to say that's a bit like being military advisor to the Pope. I made that comment on a program with Kissinger recently, good friend, he's almost 90, and he said, that is correct. He said, I want to add, Fred went on to have a distinguished career in the Carter administration, something quite difficult to have achieved. So as usual, Henry got the last word. Rohinton also said, USA Today called me one of 10 people who could change your life. And that's only half the quote. The full quote said, one of 10 people who could change your life that you never heard of. Second part was probably more accurate than the first part. Well, I come to you from Washington, where, as you know, our government may be about to shut down. Our national debt may be about to be repudiated. All of which leads to the obvious conclusion that our Congress cannot agree on anything. So it may come as a shock to you to learn that there is one thing that our Congress can agree on. And that's the topic of my lecture tonight, the evils of currency manipulation and the risk of currency wars. You may be surprised to learn that as recently as 2 days ago, Tuesday of this week, a bipartisan group of 60 senators sent a very strong letter to the President of the United States insisting that he deal with this problem of currency manipulation if they are to approve the big trade negotiations that he, the President, has now entered the United States into across the Pacific, the so-called Trans-Pacific Partnership, and with Europe, the so-called Transatlantic Trade and Investment Partnership. 60 senators, bipartisan, have said, if you want that deal, you're going to have to include the currency issue in it because it's too serious to ignore. That letter from the 60 senators follows on a letter only a month ago from 230 members of the House of Representatives, that's a majority of our House, also bipartisan, with the same message. As far as I can tell, this is the only issue, repeat, the only issue on which there is bipartisan, bicameral agreement in the United States. It's not on the radar screen of everybody at this point in time, but it is a kind of rare instance of where attitudes in our country are starting to come together. And it's therefore my topic tonight. I will shock you perhaps a second time by telling you I agree with the congressman, that they're correct to focus on this issue, that they're even correct to threaten conditioning their approval for future trade agreements, important as they are, on serious addressing of the currency problem. And so what I want to do tonight is explain why I take that view, some suggestions for how it can be remedied, and how it fits into the context of international governance, which is such a focus here at CIGI. I should say at the outset that we at our Peterson Institute for International Economics in Washington deeply appreciate and greatly enjoy the very close relationships we have with you all here at CIGI. We're in fact hosting a joint session together in Washington in just 2 weeks. We look forward to even more extensive cooperation between our institutions going forward over the coming months and years. And this topic, where I will focus on the shortcomings of the international monetary system and how it needs to be reformed to deal with this currency problem, are cardinal cases of shortcomings in international governance that are the bread and butter of CIGI here in Waterloo, but also of what we try to do at our institute in Washington. So I'm going to address 6 central points, which I'll just flag at the outset and then elaborate. Number 1, international currency conflict is very sizable and very widespread, and it could get a lot worse. Second, that the currency conflict has very large economic effects, especially on the United States and the weak peripheral countries of the Eurozone, but also on Canada and a number of other countries that do not intervene in the currency markets, I say to the Deputy Minister. Third, that these developments, these ill effects of global currency manipulation, stem from a gaping hole in the international economic architecture. Indeed, the most fundamental flaw in the entire global regime, which encompasses both the monetary and trading systems and indicates a massive failure of international cooperation. Fourth, that there is a feasible set of effective systemic reforms that can be adopted to counter the objectionable practices now and deter them in the future. Fifth, that it is very much in the interest of all of our countries, the major economic powers, to initiate a major effort to do so multilaterally, but that it may turn out that a coalition of the willing, which hopefully would include the United States and Canada, would be willing to act on its own if necessary to start the ball rolling. In short, it is time to declare war on the currency wars and work out a constructive solution to a very major international and systemic problem. I thus believe that the international monetary system faces a clear and present danger, the danger of currency wars. The reason, the simple reason, is that virtually every major country is seeking weakening, or at least non-strengthening, of its currency in order to strengthen its economy and create jobs. All of you study economics here or have in the past, and you know that when a currency is too strong, it makes the prices of all the products sold by that country too high, reduces its ability to compete in world markets, weakens its economy, destroys jobs. And the flip side, on the other side, of the current countries that are keeping their currencies too weak. I and my colleagues at our institute in Washington have identified more than 20 countries that have been intervening directly in the foreign exchange markets for this purpose for a number of years, resulting in cumulative buildups of foreign exchange reserves exceeding $10 trillion and averaging about $1 trillion per year in recent years. Now, think of it for a minute. There are over 20 countries, about 24, that are intervening every day in the foreign exchange markets to the tune of $1 trillion a year to keep their currencies weak and push other countries' currencies too strong, with the competitive effects and economic effects I have mentioned. These countries do so mainly by buying dollars and euros, the internationally used currencies, to keep those currencies overly strong and their own currencies weak, mainly to boost their international competitiveness and trade surpluses. Most of these countries have continued this practice straight through the recent bout of unwelcome currency weakness in a few other emerging markets, and in fact, that will wind up making the problem worse. The list of these currency manipulators, as I will deliberately and pejoratively call them, includes some of the largest economies in the world, both developing and developed. The group is, of course, led by China, which has been the manipulator above all for a decade, but it includes a number of other Asian countries, a number of oil exporters, and even a few Europeans. The countries that practice this egregious behavior account for almost 1/3 of the world economy and 2/3 of global trade surpluses come from their practices. China is the centerpiece, but when you broaden the list beyond China, you double the economic magnitudes that are involved. Currency manipulation is not only very large, it is very widespread. Now, what are the economic effects? We've done very careful analysis of the economic impact of all this, and what we conclude is that the currency manipulation, and therefore the distortion of competitiveness between countries, enables the manipulators to increase their trade surpluses by somewhere between $500 billion and $1 trillion per year. When you do that, you create corresponding trade deficits in the countries on the other side of the equation. So think China on the one side, the US on the other side, having these massive trade imbalances in large part because of the currency manipulation. And when countries are adversely affected, like the US, but I would submit Canada as well, certainly the Eurozone, those countries then run big trade deficits, that subtracts from their economic production, that destroys jobs. And since all of our countries are primarily concerned with creating jobs in this period of relative economic weakness and prolonged recovery from the Great Recession, that is a very serious matter indeed. Our analysis shows that the largest loser in absolute terms by far is the United States, whose trade deficits have been several $100 billion per year larger as a result, and the U.S. has lost anywhere from 1 to 5 million jobs as a result. Now, it will not surprise you that that last point, the big job loss, several million jobs lost in the United States, that was what was picked up by these groups of congressmen. Both the 60 senators in their letter of this week, the 230 congressmen a month ago in their letter to the president, both quoted our study, my study, and cited these job losses in summarizing their case as to why action was absolutely essential and why they were not going to approve any more trade agreements until the issue was dealt with. On our analysis, Europe is the second largest loser, with trade deterioration in the range of $100 billion or so, and a lot of research in the International Monetary Fund and the European Commission itself shows that the currency manipulation, particularly by the Asians, but also by some countries near Europe, like Switzerland, have been major factors in weakening the economies of the weak countries in the Eurozone, Italy, Spain, Portugal, Greece. In other words, this currency manipulation, in addition to shifting huge amounts of production and jobs around, has been an important causal factor of the euro crisis, which has brought the world close to financial brink in recent years, is now, we think, on the mend, but has been a very close call and is a continuing economic weakness in the world. Now, on top of all this, the global trade imbalances and the currency manipulation that has been one of their major causes also played a central role in bringing on the recent global financial and economic crisis. And let me explain that. The trade imbalances reached their peaks back in the middle part of the previous decade, 2005, 2007 or so, at which point the countries that were running these big surpluses, of course, had to do something with their earnings from those surpluses. You've got a trade surplus, you pile up reserves, and you've got to invest those reserves somewhere. Most of them are in dollars, some in euros. So what those countries did was invest their money in the United States. And that had the impact of increasing the supply of money in the US, making it very difficult to tighten monetary policy when the Federal Reserve wanted to in 2004, 2005, created a loose set of monetary conditions that both inflated the economy and weakened the incentive for financial regulation. And if it occurs to you that those were the primary causes of the global financial crisis, you would be right. Now, of course, the Chinese and other countries piling up these surpluses did not force the US banks to make stupid subprime loans. and do the kinds of things that immediately produce the crisis. But their currency manipulation played a central role in creating the economic and monetary environment that laid the foundation for the crisis, which had such devastating effects on the world economy, as well as the United States, as its epicenter. Now, these reserve buildups and imbalances I'm talking about have declined a bit lately. China, in particular, has let its currency go up substantially and sharply reduced its trade surplus. But the Chinese currency, all of the Asians, the others I talked about, remain substantially undervalued, including by very large amounts. Moreover, a lot of the reduction in the deficits on the U.S. part, for example, have been caused by the Great Recession. When you have a recession, your demand for imports, like everything else, declines, your trade deficit declines, but that's a temporary factor, we all hope and believe, and the IMF projects that these trade imbalances are going to start getting bigger again, and the problem is likely to rise further. And there are signs they've already begun to do so, especially in China. Its reserves went up more than $150 billion in the first half of this year. That means that they're intervening to the tune of more than $1 billion per day in the currency markets, again, to keep their exchange rate weak, to keep our exchange rates strong, and distort competitive positions as a result. The latest estimates we've done at our Institute of Exchange Rates shows that the Chinese currency, the renminbi, would need to rise by at least 15% on a trade-weighted average to eliminate these distortions. And that means it would have to go up by about twice that amount against the US dollar, the Canadian dollar, and some of the other key currencies. So the point is that there are very big imbalances. The international institutions worry about this. The G20, the G7 have continued to inveigh against the global imbalances and emphasized again at their latest meetings to avoid exchange rate targeting. Brazil, in fact, has taken the issue to the World Trade Organization, but nothing much has happened. Now, the outlook, I would suggest, is most worrisome because some of the world's largest and richest economies have already joined or seem to be contemplating joining the currency wars. If I gave you a quiz and asked you what country was the world's largest currency manipulator last year and told you the answer was not China, I think you'd probably be hard-pressed to come up with an answer. The answer is no, not even Japan. Germany doesn't intervene because it's the euro. Switzerland, the right answer. Switzerland, little Switzerland, but a huge player in world trade, one of the dominant trade partners of the European Union, has essentially pegged its exchange rate, kept it from going up against the euro, even though it's running one of the biggest trade surpluses in the world at a time when its major trading partner, the Eurozone, is in recession. It doesn't hang together. It's, again, beggar thy neighbor, currency manipulation, aggressive and unacceptable behavior. Japan did trigger the latest wave of concern. Those of you who follow it know that a new government took over in Japan last fall, the Abe government. As that government was getting elected and then coming into office, it very aggressively said that it wanted a weaker exchange rate for the yen. It used what we call in the business oral intervention. And boy, was it effective. It drove the yen down 30% against the dollar. That, among other things, enraged the U.S. auto industry, which competes with the Japanese automakers, but more widely gave Japan a huge leg up in international competition. They subsequently adopted a policy of monetary expansion that kind of ratified what they had done, but clearly it was their initial intervention that had knocked the yen down. The president of France has called for a weaker euro. Some perceptive British observers believe that its officials have been subtly talking down the pound. So a lot of intervention occurring, big countries as well as small, rich countries as well as poor. This is a very widespread practice. Now, the concept of defensive intervention enters the picture at this point. There are a number of countries whose currencies have become overvalued, been pushed up by these manipulative practices and produced external deficits for those countries. And so those countries have had to intervene defensively to keep their exchange rates from going up even higher, pricing them even more and more out of their markets. That's totally justifiable, in my view, because otherwise they're being pushed farther and farther into deficit, taking bigger and bigger economic costs. Brazil has been a noteworthy case in point. New Zealand has done it recently, Australia. So a number of countries have acted. The United States, the biggest deficit country, has not. The Eurozone has not. And that's part of the problem that I'm focusing on here today. The systemic problem that I want to focus on in my remarks arises with the maintenance of significant and continuing currency undervaluations generated primarily through substantial and prolonged intervention. And the global macroeconomic picture heightens those risks considerably. As all of you know, fiscal policy, budget policy, is constrained in almost all of the rich economies by large debt burdens. Canada's done one of the best jobs on this, actually, and stands above practically everybody else. But most rich countries have not, and therefore cannot expand fiscal policy to deal with their economic weaknesses. Indeed, they have to be tightening fiscal policy because of budget problems. The result is widespread reliance on monetary policy, including QE, quantitative expansion, in the United States, in Japan, and elsewhere. And that reliance on monetary policy to expand economies has led to charges against the United States and Japan, the British, and a few others, that they too are practicing competitive devaluation, because when you expand your money supply, reduce your interest rates, that tends to weaken your currency. So some people have said, well, that's exactly what you're complaining about with China. You're doing it yourself. No. The reason is because monetary policy is carried out for domestic purposes, with domestic instruments, and in a way that, yes, has some spillover on the currency markets, but is primarily an internal policy device. Whereas the intervention I was talking about is directly in the currency markets, aimed pure and simple at international pricing and national competitive positions. Nevertheless, if you're on the receiving end of the resultant capital flows, like Brazil and some others, it kind of looks to you like what the U.S. is doing with monetary policy is not so different from what China is doing with foreign exchange intervention policy, and therefore you can be somewhat excused for conflating the two, and throw in the defensive intervention too. So you've got three different kinds of policy actions, which are often conflated in public understanding and even the policy debate, all of which adds to the risk of currency conflict because it makes it appear that the problem is even worse than it is. The bottom line is that we have witnessed extensive competitive currency depreciation for a number of years, and the practice is widespread. Much more seems quite possible in the near future. The economic damage that has already resulted is immense and could become much worse. It is worth noting that this is quite similar to what happened in the 1930s, when a wave of competitive currency depreciations deepened and broadened the Great Depression. Indeed, many historians believe that it was the transmission of national recessions from country to country, England, US, France, Germany, and back, that brought on the Great Depression and globalized the problem at that time. When the architects of the post-war economic system got together to create the International Monetary Fund, the World Bank, the so-called Bretton Woods system, their central concern was to avoid a replication of that problem from the 1930s. And so they wrote very firm rules into the charters of the IMF, the World Trade Organization, or the GATT as it was then, to proscribe this kind of currency manipulation. Unfortunately, they failed to put any enforcement mechanisms into the rules. And so, though the rules are there, the implementation is totally absent, and the system has totally failed to deter or respond to the practices that I am describing. I view this as the single greatest flaw in the entire international financial architecture. its failure to effectively sanction trade surplus countries, especially to counter and deter competitive currency policies. Indeed, this systemic failure almost assures that the problem will continue because the manipulators get away with it and thus are presented a policy option, especially attractive in tough economic times like now, through which they can subsidize their exports, subsidize domestic competition against imports, thereby subsidize jobs without any budget costs domestically or without any effective restraint internationally. It's just too good an alternative to pass up, and many countries have now learned that fundamental fact. Now, you might ask, why is it that the system has failed so badly? Even without good enforcement rules in the IMF and the WTO charters, you might say, well, but why couldn't the big countries get together and do something about it, as they have on some other issues in the post-war period? I think there are two plausible and complementary explanations. One is primarily political and one is primarily financial. I had a professor in graduate school a long time ago named Charlie Kindleberger from MIT that you may have heard about. He had a very simple but very persuasive thesis of why the world economy did collapse back in the 1930s and what we had to watch out for now. His thesis was that a world economy could function cooperatively and effectively only under firm, enlightened leadership by whatever country or small group of countries had the economic clout to lead that system and exercise that clout in a constructive way. And his insight was that what happened in the 1930s is that the traditional and previous global leader, the United Kingdom, was no longer able to exercise that leadership. It had lost World War I, its finances had been decimated, its economy was weak, it couldn't do it anymore. But the rising power, the United States, was unwilling to step into that breach, exercise a leadership role, and thereby keep Humpty Dumpty together. And that explanation, which of course is political economy, not theoretical economics, is in fact quite powerful and quite persuasive. The analogy today would of course be that the United States has declined in its economic clout and so can no longer lead the system, but that the rising power, China, is certainly not yet willing or able to do so. And you therefore get a vacuum of leadership, nobody to see to it that the rules do get implemented, take matters into their own hands to do that if necessary, as the US has done in some previous periods. And therefore, nobody's minding the store and things devolve and fail. And that is, I think, one rather persuasive explanation of what happens. It's worth a word about why China can't do it yet, because China is clearly the rising power. It'll be the world's largest economy within the next 5 to 10 years. It's already the biggest trader. It's by far the biggest surplus country, $3.5 trillion of reserves, more than 3 times as much as anybody else. All this ill-gotten to a large extent for the reasons I've been describing. But it means that China has become a global economic superpower at this fairly early stage in its development. But it's a very unique economic superpower. It remains a relatively poor country. Its per capita income is about 10% of ours, even though its total economy is getting quite close to ours in absolute magnitudes. Its economy has not yet fully marketized or privatized. It retains extensive capital controls, a currency that's not yet convertible, so it's not really yet a modern economy. Its political system, of course, is hardly compatible with those of the traditional economic powers. So it would be a bit premature, to put it mildly, to expect China to shoulder the kind of global economic leadership that's needed to deal with a problem of this type. Indeed, as I suggest, China is a large part of the problem rather than a leader in resolving it. The US side of the equation, though, is worth a little description, particularly here in Canada, our closest trading partner, largest trading partner, close ally. The United States is caught in something of a scissors movement in terms of its role in the world economy. On the one hand, the United States has become increasingly and in some senses critically dependent on the world economy, at least 4 times as much as when I entered this business in the early 1960s. At that time, the international dimension represented about 10% of the U.S. economy. Today it's 40. It's quadrupled in 50 years. On the other hand, the U.S. has become decreasingly able to influence, let alone dominate, the outcome of global economic developments, with half the share of global output it had half a century ago. At that time, the U.S. share of the world economy was 40%. Now it's 20. So the U.S. dependence has gone from 10 to 40. Its clout has gone from 40 to 20. In short, a scissors movement that has crossed, with the U.S. much more dependent and much less able to exercise the kind of leadership it did in the past. And that has seriously truncated the ability of the United States. Both trends have accelerated over the last decade. From a U.S. standpoint, time is not on its side in seeking to promote its global economic interests. But I believe there's an even more fundamental, if very subtle reason for both the systemic erosion that I talk about and its adverse consequences for the United States, and that's the international role of the U.S. dollar. Whether you're talking about fixed exchange rates way back prior to 1971 or floating rates since, there's a basic asymmetry in the way the exchange rate system works. The dollar is, of course, by far the most widely used currency. And therefore, you have a world of what we call in technical terms N currencies, the number of currencies in the world, but only N-1 exchange rates, because one exchange rate has to be the residual of all the others. So the United States is expected to remain passive in the currency markets, and the exchange rate of the dollar is to a substantial degree determined by the combined actions of other countries, including this direct, indirect, oral intervention that I talked about before. Global monetary arrangements are in fact based on an implicit grand bargain in which the U.S. accepts the deficits that result from the dollar's role, and other countries finance those deficits without complaining too much. Now, the conventional wisdom is that the international role of the dollar is very much in the interest of the United States and bad for the world. The opposite is true, in my view. Other countries, Canada, others, clearly benefit from the convenience and cost reduction of a single world currency and, for the manipulators, the ability to set the dollar's price in terms of their own currencies. But the United States has 2 very tangible costs. As I indicated, other countries can determine the exchange rate between their currencies and the dollar by buying dollars in the foreign exchange markets. And on the monetary side, the buildup of dollar balances by other countries, very directly from a result of intervention, mean that a big flood of money comes into the United States, inflates the money supply, weakens the ability of monetary policy to cope, and therefore can lead to results like the global economic and financial crisis that occurred over the last 6 or 7 years. It's very interesting that the Chinese recognize the validity of what I'm talking about. The governor of their central bank, Zhou Xiaoshuan, who's very sophisticated, made a famous speech about 4 years ago on the monetary system, and he seemed to be inviting the United States to get out of the business of running an international currency by noting that, quote, when a country's currency is no longer used as the benchmark for other economies, the exchange rate policy of the country would be far more effective in adjusting its economic imbalances. In other words, he was saying, you Americans complain about our Chinese currency manipulation running big surpluses, but that's because your dollar is the currency in which we do it. If you'd get out of that business, we could no longer do it. You'd be more independent and autonomous, and you wouldn't have the problem. Well, that was a provocative and far-reaching suggestion. It has not been operated on to this point, but it's probably got a lot of truth. The U.S., to be sure, benefits to some extent from the international role of the dollar. It makes it easier to finance trade deficits over short periods of time, which is always very attractive to politicians. The problem is that the international role of the dollar represents the ultimate moral hazard for the United States. It's an absence of market pressure on the U.S. to adjust its economic policies when it should be doing so, like the boom period of the early and middle 2000s, to keep its imbalances, both its trade imbalance and its internal budget imbalance, which are closely related, to keep those imbalances from reaching unsustainable levels that may require very sharp and very costly correctives, as we are seeing now. The U.S. budget problem now, the U.S. trade deficit now are directly related to the failure to act earlier, which was permitted by the buildup of dollar balances by other countries financing the United States. There is, in fact, some similarity between the huge inflows of capital to the United States that I'm describing and the huge inflows to Southern Europe in the early years of the euro that brought on the euro crisis. Both of those big capital flows reflected market judgments driven by key features of the institutional framework that kept interest rates very low in the capital importing area. What happened in Europe, as I suspect you know, is that the market, once the euro was created, the markets treated Greek debt the same as German debt. The market said these are all members of the Eurozone, there's not going to be any exchange rate movement, these are all part of the same economic union, so we price their government paper pretty much the same. And so the Greeks were able to borrow at the same rates the Germans were able to borrow. It's no surprise, therefore, that the Greeks went on a huge spending splurge, shopping spree, overspent, overborrowed their books, lived way beyond their means, and finally crashed. And I'm suggesting that although the time fuse is longer because the U.S. is a much bigger economy with much greater resilience, there are some similarities. That the U.S. runs large external deficits based on large internal deficits. The rest of the world, because it, quote, doesn't have anywhere else to go, tends to finance those for a long time until it decides to stop financing them. And then, as happened with Greece, Italy, et cetera, the interest rates will jump, the shoe will begin to pinch, and then all of us, including in Canada, given its proximity to the United States, will be in big trouble. However, lots of Americans, unlike me, believe that this international role of the dollar is a good thing for the United States. I call it dollar primacy mentality. I think until it is overcome and there is a widespread recognition that at best the dollar is a mixed blessing for the United States and probably on balance a weak factor and a negative, until that is overcome, I suspect we will not get a termination of the currency manipulation problem and remedial action. What is interesting, and I'll go back to my lead-off story, what is interesting is that the Congress of the United States seems to understand this. Now, you might say the Congress of the United States is typically thought of as being pretty chauvinistic and pretty nationalistic and pretty narrow-minded and even kind of xenophobic and isolationist. But just to throw out a few adjectives that normally describe our Congress. But in this case, the Congress seems to have recognized that this dollar primacy mentality that I call it, which is rampant in Wall Street and in some parts of our business community, is a huge mistake in terms of the strength of our economy, the creation of jobs, the maintenance of external and internal balance, and the sustainability of the American economy. And it is fascinating when the Congress gets it and the administration does not. I'm no anti-Obama speaker, I can tell you. I've supported the Obama administration in large part. But in this area, the Obama administration, the Bush administration before it, and most administrations before them have all been short-sighted on this issue. And finally, the Congress, I think, as I said, is beginning to force them to act. Well, that's the problem. So what is to be done? Systemic reform is clearly required. And it needs to include both changes in the rules and particularly much tougher enforcement of those rules. And to relate directly to what you hear at CIGI study all the time, the governance structures through which the rules are implemented must, of course, also be substantially revised to legitimize the new regime and to promote both its initial acceptability and thus its sustainability. I believe that these systemic changes to deal with this huge systemic problem need to occur both through the International Monetary Fund and the World Trade Organization. It's a problem that cuts across monetary issues, trade issues, both need to be deployed in response. Now, both these institutions, as I've already said, have rules against competitive currency undervaluation. The IMF rule is actually clearer, but it has no enforcement mechanism. The World Trade Organization does have an enforcement mechanism, but its rule is much more ambiguous and has never been attempted and probably would not work if it did. The United States has been trying for a decade to persuade China to let its currency go up much faster and by larger amounts, but its success has been very modest, importantly due to the absence of effective international rules and procedures that it could mobilize for that purpose. In the case of the IMF, the chief need is to add effective policy instruments to enforce the two existing rules: the proscription of significantly undervalued exchange rates that are maintained by protracted large-scale intervention in one direction, and a failure by violators to consult with the country in whose currency they plan to intervene. The IMF rules should thus be reinforced to provide for the first time effective sanctions against countries that meet a two-part test. First, maintenance of a significantly undervalued exchange rate. Second, through extensive intervention in the currency markets, as I've described. I propose that a new sanction be brought into the toolbox. It's what I call countervailing currency intervention. If Japan, to take one of the most recent focal cases, if Japan buys $1 billion of dollars to keep the dollar overvalued and the yen undervalued, why shouldn't the United States do the reverse? Buy $1 billion of yen to push the yen back up and the dollar back down, and to offset, counteract, countervail the effect of what the Japanese have done. That would be meeting the punishment, matching the punishment to the crime. It would not be a huge cataclysmic impact on global financial markets. And I think if the United States did it 2 or 3 times, it would successfully deter other countries from carrying out the practice, because then they would know that it would have no benefit and everybody would wind up where they started out. A measure of that type, and I deliberately call it countervailing currency intervention, would parallel a very widespread trade policy rule under which countries can apply countervailing import duties, tariffs, against export subsidies that are prohibited. This currency manipulation is the same as an export subsidy. It keeps the prices of exports low, and therefore a similar response in kind, but this time through the currency markets, seems to me to make perfect sense, should be done, and would be a directly applicable remedy. If the country that was being intervened against felt that it was being unjustly treated, it could protest to the International Monetary Fund. If it was found to be right and the countervailer was found to be wrong, well, the IMF could tell him to desist and he would have to do so. That's why it's important to embed the new rules in the international system so that nobody will try to bully anybody else in the process. A second new policy instrument would be to tax the buildup of foreign currency reserves that are the results of the intervention. As I said before, when China buys dollars to keep its currency weak, it has to invest those dollars somewhere back in the United States, and it gets interest on those. Well, we could tax those, or we could even stop paying interest, or we could even prohibit their holding increased amounts of dollars in order to make clear that we wanted no part of their currency manipulation. That, too, I think, would be a perfectly logical response, and for technical reasons, you might need to do that with countries that have inconvertible currencies like China. So those would be the new instruments on the monetary side. There are 2 changes that I think could also be made on the trade policy side. People immediately say, but that's protectionism, but remember, what we're responding to here is protectionism. This is anti-protectionism, because when countries manipulate their currencies, keep them undervalued, run these huge trade surpluses, it's the equivalent of big export subsidies big import barriers. In fact, I would argue that the Chinese currency intervention of the last decade is the biggest protectionist policy in the history of mankind. We've actually calculated the numbers. It's much more significant than the Smoot-Hawley tariff that the United States put on in the 1930s or any other trade policy device that we could ever find in the history of the world economy. This is huge stuff, as I said before. So, if you want to deter it and or respond to it to protect your economic interests in the short run, there are two things you could do on the trade side. One would be to add manipulated currency intervention that I'm describing to the list of prohibited export subsidies against which countervailing import duties could be levied. A currency manipulation is just like any other export subsidy in terms of driving down the price of the exported product. That's perfectly legitimate under the trading rules as they exist today to put on a countervailing tariff against those. The only issue is whether the currency intervention counts as an export subsidy. That's a hotly debated topic. It has not been defined as such by most countries, although Brazil has begun to do so. I think the United States, Canada, and others should do so. Again, the deterrent effect on the countries that manipulate would be quite significant. A second and even more significant trade action would be to invoke an existing rule in the WTO. There is a rule that says any country that frustrates the intent of the agreement, the trade agreement, through currency manipulation justifies the erection of across-the-board import barriers against it. An across-the-board import surcharge or some equivalent measure that reacted across the board, not just case by case, as with countervailing duties, to a country that was manipulating its currency for trade reasons. That would be big stuff, but again, it would have major deterrent effect. You could make those changes either through amending the charters, the IMF or the WTO, or by, more likely, just developing a consensus on the issue and doing it through a coalition of the willing, as I mentioned before, a subgroup that was willing to move ahead in that way if you could not get widespread agreement. Another tactic, and this brings me back to conclude to where I started with the Congress, is to build rules of this type, including sanctions, into new trade agreements. And this, of course, would be directly relevant to Canada because Canada is a participant in the Trans-Pacific Partnership negotiation that's trying to forge modern trade rules, open markets, expand trade and investment among all the major countries of the Pacific Rim. If it succeeds, it'll be the biggest trade deal in history next to the European Union, and it will be a major game changer in terms of trans-Pacific security, political, as well as economic relations. That is the agreement that our Congress is now saying they will only approve if it addresses this currency issue. And so what they're suggesting is that as our countries, including Canada, negotiate this new trade agreement, that they add one more chapter. There are 29 chapters in the agreement now. It's a very complex and far-reaching trade agreement, which is its virtue, though also its difficulty. But they're saying, the congressmen are saying, add one more chapter, a crucial chapter that would address this currency issue. And the chapter, though nobody's worked out the details of it yet, would basically repeat the prohibitions on currency manipulation, as are in the IMF now, would subject the issue to the dispute settlement mechanism of the whole trade agreement. In other words, if one participant, say Australia, feels it's being adversely affected by another participant, Mexico, Australia can take Mexico to the dispute settlement mechanism of the agreement and say, hey, they're violating the prescription on currency manipulation. If the dispute settlement mechanism, it's all multilateral, says, you're right, Australia, then either Mexico has to desist or Australia is authorized to withdraw all the trade concessions it gave Mexico in the agreement. What's called in the trade policy jargon a snapback of the trade liberalization that had been implemented. And nobody wants to deliberalize trade, but if you don't have an effective deterrent to the practice, then the practice continues. And so the idea would be to start using new trade agreements. The Congress says not just this Trans-Pacific Partnership, but all future U.S. trade agreements should have effective mechanisms to deal with this currency problem, or else we, the Congress, are not going to implement what you've been thinking of. Now, that's not the ideal way to go about it. It would obviously be better if you could negotiate these reforms internationally and multilaterally. But we know from the last decade of trying to get international agreement on this issue that it's not very likely we could do so. I think there is a potential pretty widespread coalition of countries that are adversely affected. The United States, the Eurozone, a number of emerging markets have been very vocally critical, Mexico, Brazil, India, critical of China and the other manipulators. So I think there are a number of candidates for a coalition of that type, which then could begin to put those new international concords into practice and begin to deal with the problem. Hopefully, once that happened, you could then formalize the multilateralization of the rules, put it into the institutions, and make it a new feature of the system. As I indicated, the fathers of the post-war monetary system way back at Bretton Woods tried to proscribe these practices to avoid a replication of what happened in the 1930s. They failed to do so. Now would be the time to complete that process 70 years later. The conclusion is that such systemic reforms and/or plurilateral actions along the way to terminate the contemporary currency wars would have substantial payoff for the countries that are adversely affected by the current competitive depreciations. The U.S., for its part, could see its trade deficit cut by several $100 billion per year, and its unemployment rolls drop by at least a couple of million. The Eurozone, as I said, would be the second largest beneficiary to the tune of $100 billion or so, and a very large number of jobs. And if the issue could be put to rest in these relatively constructive ways, I think the threat of protectionist trade policies and hard landings in deficit countries with overvalued currencies should recede substantially. For the longer run, the benefit of all this is that the greatest flaw in the global economic order of the past 70 years would be overcome. The system would become much stronger in responding to large imbalances and to heading them off by deterring predatory currency policies. The institutional pillars of the world economy, the International Monetary Fund, the World Trade Organization, would become far more effective and far more credible. President Obama addressed another vital issue of U.S. interest in which China also plays a central role back in his State of the Union message in February, cybersecurity. And he said the following, quote, "We cannot look back years from now and wonder why we did nothing." More recently, when he was discussing Syria, President Obama referred to the global prohibition of chemical weapons and said, "The question is, do these norms mean nothing? And if we're not acting, what does that say?" He added, "When there's a breach of a norm of this importance, and the international community is frozen and doesn't act, then the norm begins to unravel." Well, I would submit that we should adopt the same attitude toward widespread currency manipulation, which violates the most basic precepts of the international economic system while destroying growth and jobs in numerous economies. I would submit that the time for action has clearly come, and it is time to declare war on the currency wars. Thank you very much.
Good evening, ladies and gentlemen, and thank you, Fred, for a very powerful and articulate speech, and it's a pleasure to be here with truly one of the world's great international economists and international policymakers. So I'm humbled to be the person who has to respond and continue the discussion. Let me just make one point to start off with, which is that in Canada, we have had a long-standing policy in Canada. We believe in flexible exchange rates. We've believed in it for a long time. And so the idea that we should have greater exchange rate flexibility in the world, I don't think is one that you will find much disagreement with here in Canada. But let me just perhaps pose some questions and try and get your reaction. My first set of remarks has to do with actually China itself. I mean, one argument that one could make for greater flexibility is that it's actually in China's interest, not in the interest of everybody else. I mean, if you look at the kind of accumulation of foreign assets that is required to prevent the appreciation of the renminbi, much of it in low-yielding U.S. Treasury bills, sitting on huge stock of that, the prospect of the U.S. dollar declining over time, so a huge capital loss on a stock of assets that China is holding. There's a question. China has been fairly effective in sterilizing those inflows. However, I don't think it's been perfectly sterilized, and so there's the risk, and we see it on occasion, of inflationary pressures building up in China, and is that a good thing for China? One could argue, again, that China now is over-dependent on export industries, taking in huge stocks of foreign capital, sterilizing it, putting it into the financial system, lower interest rates in China, that coupled with problems in the financial intermediation system in China, and you have potentially huge issues of misallocation of capital in China, and the exchange rate regime being part of the problem for that. We have household savings in China very high. Part of that has to do with the demographic situation in China, one-child policy, an aging population, the lack of social safety nets in China, so that we have people are seeing low rates of return on their savings in financial institutions and then seeking other places to put their funds, including housing, with the potential for housing bubbles to develop in China. So I guess I just asked the question. I mean, one could credibly make the case that greater flexibility of the renminbi is actually in China's interest, not only in the interest of the United States or other flexible exchange rate countries. I guess I do point out that the Chinese now, their latest 5-year plan has basically kind of recognized that it wants to move in that direction. And indeed, the renminbi has appreciated by about a third over the last number of years. So I can appreciate a certain frustration, perhaps, that we all have with the slowness of the pace of the adjustment, but that adjustment seems to be taking place in China and in the interest of China to do so. I guess a second series of questions I would have really has to do with, I guess, the economy and the political economy of the United States. You can ask yourself how much of the manufacturing loss in the United States is due to currency manipulation, and you make a powerful case that a large part of it is due to currency manipulation. Another argument could be made that, other countries in the world are just more efficient manufacturers of consumer goods than the United States. And so part of the decline in those industries in the United States, some of it may be due to currency manipulation, but some of it could be due to the fact that other economies are more efficient in producing those goods. The other thing is that, the export subsidy, as you call it, of having a fixed exchange rate regime, does have the effect of subsidizing consumer goods in the United States and elsewhere. And while there seems to be a strong coalition in the United States, I wonder what the impact would be in the United States when people realize that probably the outcome of all of this is actually an increase in the kinds of consumer goods that people have become used to in the United States at a certain price. Alternatively, we could see dealing with China not being a currency manipulator, but is that production going to shift from China to the United States, or is it going to shift from China to somewhere else? And so that you don't see actually the gains that one might expect in terms of production in the United States itself. I guess another point, and it really comes down to, again, a question of sort of the political economy in the United States. I mean, China, I think, has been very clever in terms of, involving itself in global supply chains, a lot of foreign investment in Chinese enterprises. Only about 50% of the export price of goods in China is actually Chinese value added. It's value added from elsewhere in the world that they put together in China. The other thing is that the savings, these savings are actually a subsidy for the rest of the world in terms of investment as well. Cheap savings have had a positive effect, potentially, in terms of investment elsewhere. I take your point. Some of that investment, though, has to be done with kind of strict financial regulation and very prudent regulation, supervision of financial markets. But one could arguably say that at least part of what is happening with the Chinese situation is that they're providing cheap savings for investment elsewhere in the world as well. My only point here being not to deny many of the concerns that you raise, but there are also countervailing forces that would suggest that you have to kind of pause and think about what are the net consequences of it all. Finally, I just raise perhaps more technical issues. I mean, as an economist, I know determining the equilibrium or fair exchange rate, I mean, there are a number of models. This is a hellishly difficult thing to do. The IMF itself has about 3 models for exchange rate. What is the equilibrium exchange rate determination? I suppose one could leave this to the technicians and the econometricians. But you have to be careful when you think of these kinds of regimes about avoiding substituting a degree of arbitrariness for a degree of fairness. And so that would have to be done, I think, very carefully. I guess the only point here is, you also wouldn't want to have a system where you run a large risk of type 1 errors, where you have false positives with real consequences for international economy and real effects on people worldwide. So you would have to have a regime that has a lot of safeguards, I would think, built into it. Anyway, those are just a few comments to stimulate the discussion. Thank you.
Thank you. So I'd invite you in the audience to go to one of our microphones and ask a question of either Fred or Michael. And while you do so, Fred, would you like to respond
Sure.
to some of the points Michael?
Yeah, let me do that. All of Michael's comments are very well taken and thoughtful and raise legitimate questions about my thesis. His overview comment that there are countervailing forces to those I laid out, and therefore it's not such an easy call, is of course correct. If it was an easy call, probably would have been done some years ago. So there are these factors on various sides. In economics, we frequently say there's no free lunch. So it's true that US consumers, Canadian consumers, benefit from cheaper Chinese products because the Chinese are subsidizing our consumption. That's correct. But they're also subsidizing their own job creation and much higher unemployment in our countries. So we then have to make a value choice. It comes down to a value judgment at the end of the day. Many theoretical economists say, what's the complaint? If they want to subsidize our consumption and send us goods cheaper than it costs them to produce them, why shouldn't we just sit back and be happy about that? Well, if we were happily chugging along at full employment and 4 or 5% growth, and the economy was in great shape, and our main concern was inflation, then the answer would be yes, that's quite a wonderful thing. But if our problem, as it's now been for close to a decade, and it's going to be at least a decade before we come out of it, is the opposite: lagging production, lagging growth, high unemployment, reduced productivity, no inflation in sight, then welcoming the other country's decision to steal jobs from us with the quid pro quo of sending us cheaper product doesn't look so good. But again, it's a value judgment, which means at the end of the day, the political system has to make some decisions. And one reason I was underlining what the Congress has now begun to do in the U.S. is because I think we're getting close to the tolerance level, at least in the U.S. political system, of the trade-off that's been occurring for the last decade. But again, it's got to be a political choice, policy choice, value judgment. Michael, I agree very much with your point that cutting out the manipulation and moving to a more economically balanced exchange rate would be good for the Chinese themselves, for all the reasons you said. And all of us should continue to try to persuade them that that's the case. You and I both know some top officials in China that understand that and believe it, but they haven't been the ones making the policy. You're also right that much of the Chinese rhetoric in recent years, including the new Xi Jinping government, are correct. They've been saying the right things. We want to rebalance the economy, move away from relying on exports, generate domestic demand. They've said all the right things. The problem, and you mentioned frustratingly slow, the problem is that they have not acted that way. They have acted as if they want to continue with the model and the problems that I've described. In fact, as I mentioned, their intervention during the course of this year has gone up substantially again. It's at least $1 billion a day, maybe more. This is pervasive, very substantial cheating, bending the rules, essentially exporting your own unemployment to other countries. That's putting it harshly and strongly, but I think that's what the economic analysis suggests. If they would change their behavior, I would be the first to stand up and applaud. You're right, and I mentioned that. They have let the currency go up some. Their surpluses have come down some, but they're still piling up reserves at an incredibly rapid clip. That goes to your technical point. And again, you're of course right that determining the degree of currency misalignment is a very contentious analytical question. I mentioned the analysis we do at our institute. Our approach is used widely, including by the IMF, but other approaches compete with it, so that's quite correct. So there's actually now a tendency at the IMF and elsewhere to start moving away from trying to define a misaligned currency, at least very precisely. Rather, look at two things: the existence of large current account surpluses and buildup of reserves, which occurs through intervention in the currency markets of the type that I mentioned. In my suggestion for how to go about remedying the situation, I suggested that, whether it's in the IMF rules or new trade agreements, if a country is found to meet two tests, large current account surplus, big buildup in reserves through intervention, if it meets those two tests, it's ipso facto guilty of currency manipulation and should be required either to cut it out or to accept the consequences. Now, there'd still be an implicit currency misalignment, but you wouldn't have to define it explicitly and get hung up, as many exercises have, on these different conceptual models of how to do so. Finally, Michael raised, again, quite fairly, how much does this affect U.S. manufacturing? Isn't it just that other countries are more efficient? Well, certainly in some sectors, other countries are more efficient, including China. There's no doubt about it. On the other hand, the U.S. Manufacturing sector has roughly maintained its share of the economy now for the last 20 or 30 years at about 18 to 20%. What has steadily declined is the number of manufacturing jobs because of increased productivity in the manufacturing sector. My only point is that the decline in U.S. manufacturing or Eurozone manufacturing or Canadian manufacturing, though I can't give you the numbers, has got to be adversely affected when another country, through dint of its currency policy, underprices its product by anywhere from 20 to 40%. I mean, if we believe in market economics and price relationships, we've got to believe, and all our models show it, that big price differences of that type go a long way to determine market share and therefore the location of production and employment. And I don't see much way around that. Thank you. There's just no way around that, and that's the ballpark of magnitudes that the Chinese currency manipulation, plus I could mention lots of other trade barriers in China, amount to. So whatever the underlying trend, it is made much worse for those of us on the receiving end of those practices, and that's why I submit that the practices ought to be excised. Eric.
Thanks. Fascinating talk. And I'm very sympathetic with the overall argument. I mean, as Michael said, most Canadians have lived with a floating exchange rate for all their lives. And in fact, Canada even did this when it broke the rules. So we're not necessarily in the right always in doing that, but that's been a very consistent preference of this country for a very long time. But I was thinking about your argument from the standpoint of people who are in countries involved in reserve buildup. And I can understand the case you're making about China, but in the case of some other countries, it seems as though the reserve buildup has not been entirely a kind of a currency manipulation story, but rather, which is in a sense a mercantilist or offensive strategy in the way you're depicting it, a war, but rather a defensive kind of self-insurance motivation, really coming out of the East Asian financial crisis experience of the late 90s, where they saw the IMF behave in ways that those countries perceived as really unfair and unduly influenced by American policy goals, so in Korea or other countries. And they came out of that experience saying, we can't trust the multilateral insurance system, which the IMF is supposed to represent. And hence, we have to insure ourselves. That's the only safe strategy. And while it can come across to foreigners as currency manipulation from the standpoint of poorer countries, it looks like a protection against a misguided and failed international governance mechanism in the way that the IMF was behaving. And in a sense, those arguments were reinforced by the recent financial crisis, where countries that had self-insured found themselves able to do things that countries that had not done that could not do. So they were able to engage in counter-cyclical macroeconomic policies in a way that the IMF would never allow historically. And so I'm not surprised in a way that many poorer countries are doing even more of that in the current experience. And so I'm just trying to think about your proposal from the standpoint of those countries who I don't think of themselves as currency manipulators, but rather doing this as a kind of second best strategy in the failure, in a context where IMF reform is not progressing in ways that they perceive as desirable.
Thank you. Question at that end? Sir?
Thank you very much for being in Waterloo, and as has always been the case, Dr. Bergsten, for very far-sighted, visionary, and accessible ideas. The solutions you're presenting, I think you would admit, are much longer term, and my question focuses more on the current situation and Canada in terms of exchange rates. You've praised our purity. The United States, over the last 10 years, has, in relative terms, seen its currency decline, making it more competitive. Canadians see the higher US dollar as a major competitive challenge. I think, more truly, the real competitive challenge, particularly for Canadian manufacturing, is the volatility of exchange rates. The US exchange rate is the international reserve currency, the international benchmark. So if there's a crisis in the world, money flows into the US and suddenly the Canadian currency takes a hit. In other circumstances, commodity prices or others, it can go elsewhere. Put it very simply, in terms of how important this volatility can be, a global manufacturer or a Canadian seeking to make a major investment in a manufacturing facility will almost inevitably have 70 to 80% of the output going to the US market. The risk of that currency volatility would be a great disincentive against putting such an investment in Canada. Put bluntly, Canada's purity in a very imperfect world today with, in fact, US exchange rates finding a downside, Canada's in a fairly tough position. I'd be interested in your comments.
Great. One more question on our right.
I think he'd be interested in your comments.
Sorry?
Well, the last gentleman was interested in your comments, so I thought, aren't you going to comment?
Do you want to ask your question, sir?
No, I'm making a statement. The last gentleman asked you, he said he'd be very interested in your comments, or did I mishear him?
As soon as the chairman turns to me, I'll comment. Don't worry, I'll comment.
Oh, you're gathering all these questions. Okay, well, your memory is going to be a lot better than mine. Okay. Now, I'm really surprised to hear that the Congress is against currency manipulation because, as we all know, they're basically bought and paid for by corporations, many of whom I would think that would have a very strong interest in low-cost Chinese goods. And on the other hand, fixing currency manipulation, why do you think the Obama administration doesn't seem to have any interest in this?
Right. So let's take those three and then take a second round, if you'd bear with us.
Well, since he was anxious to hear my comments, I'll comment on him first. It may surprise you to learn that the American, you said Congress is bought and paid for by the companies who like the low-cost Chinese goods.
Well, some of the companies that like low-cost Chinese goods have obviously bought many people in Congress.
Right, but it's going to shock you to learn that by and large, the American companies are against what the Congress is now doing. And there are two reasons for that, not cheap goods. One is that many of the American firms have invested in China, and they don't want to cause problems with the Chinese government because they know the Chinese government may retaliate against them. Chinese government is very tough. When a country, be it the US, Canada, EU, criticizes them and particularly takes action against them, they will frequently retaliate against the companies based in that country. You know, they'll buy Airbuses instead of Boeings. So the US companies are deathly afraid, puts it a little too strong, but they're very reluctant to attack the Chinese government. In addition, a lot of the American firms in China benefit from the undervalued Chinese currency for their export competitiveness out of China. So contrary to what you say, the bulk of the American companies oppose what the Congress is now doing. And in answer to one other question, why the U.S. has been so slow to act, this is one of the reasons. Because the U.S. companies have not been active at all in pushing the issue. I'll put another spin on that. China has been incredibly smart in taking hostages. They have opened to foreign investment in a big way. Incidentally, U.S. investment in China is a tiny share of total foreign investment in China, about 10%. American firms are very modestly represented in China. But that's enough so that, as I've just described, when there's a big policy issue in Washington, many of the American companies side with the Chinese. So when the Congress does what it has now suggested it'll do, it's going against the interests of the American companies. So if the companies thought they bought them, they didn't buy very much. They lost out, at least on this one.
If I may clarify my point, that was what I was wondering about, because I think that, I'm surprised that Congress is going against the interests of the American.
Well, and I'm telling you, you heard my speech. There are a lot of big costs to the U.S. economy from the result. A lot of it, the most tangible cost is lost jobs. Several million lost jobs because of the Chinese currency manipulation. So then you might say, well, that's just the AFL-CIO and their labor allies. Well, but this congressional activity is bipartisan. In fact, the Senate bill was organized by a Republican senator, Lindsey Graham, who's been very active on this issue for 10 years. The 230 congressmen included about at least a third, maybe a little more, Republicans. So this is a growing recognition in the Congress of some pretty big costs to the U.S. economy, of which the best single indicator is the several million jobs, but it's slower growth, it's lower production, loss of competitiveness in general. But to stress, it's not something that the companies have pushed, to the contrary. Now, you asked why the Obama administration has not gone for it. Again, I tried to give some answers. I think a lot of it has to do with this dollar-centric mentality, as I called it, that there's a widespread view in the United States, particularly on Wall Street, that the international role of the dollar is a great thing for the United States, and anything that undermines it is to be avoided. Well, again, I've suggested to the contrary. I guess I haven't yet convinced the Obama administration, but I suspect the Congress may now be able to do so. Back over here. You surprised me a little bit by focusing on volatility of exchange rates for two reasons. There have been lots of economic analyses that try to distinguish between volatility of exchange rates, meaning bouncing around some more or less constant level, and misalignments of exchange rates when they are at levels for prolonged periods that do not accurately reflect underlying economic fundamentals. All the studies show that volatility is a very minor factor in affecting trade flows and competitiveness, whereas misaligned levels are very important. To put it in practical corporate terms, companies can usually hedge against volatility. And most companies that are active in international business do that. Now, you can't hedge with total effectiveness out 8, 10 years or more, but if you're talking in the short to medium run, out even to 5 years or so, there are forward markets, there are derivative products of all types that can be used to hedge your currency exposure, and that protects you against volatility, and most companies do that. So I suspect that's a reason why the economic analyses then show very little impact of volatility, and I would think that companies or individuals that have the kind of concerns you mentioned could avail themselves of the hedging opportunities through banks, other financial institutions, and therefore be able to obviate the effect of volatility. Eric Heliner raised a very good question about the motivation of the countries that build these reserve levels and intervention practices. And I think, Eric, the origin of the activity in the late 90s and the early part of the last decade certainly reflects at least in important part what you were saying, the experience of the Asian crisis and subsequent crises, Brazil, Russia, et cetera, where countries felt they had inadequate reserves to defend themselves against being forced into austerity programs and adjustment efforts by the IMF, the Washington Consensus, that they did not like. So I fully agree that in its origins, the policy had a lot of that element in it. What I disagree with is that the extent to which the reserve buildups have occurred have anything to do with that self-insurance motive. I mean, just to take the extreme case, China has foreign currency reserves of $3.5 trillion. Even the Chinese, in their wildest dreams, would never argue they need anything like that amount to enable them to respond to even the crisis of the century, the one that we faced a few years ago. You're right, they were able to carry out a stimulus program, so was the US for that matter, because it can borrow, as I said before. But the Chinese only drew down their reserves a very tiny amount during that period. In fact, they kept running surpluses through most of that period. So what started out as an understandable and maybe even good thing, I think just became far too much of a good thing. And the countries got in the habit of running surpluses, realized that export-led growth was something they could both get away with and would, as I said, be a kind of cost-free domestic employment policy, never mind that it's stealing jobs from the rest of the world. So I think it's the degree to which it has gone. I wouldn't say that's true for every country. There may be some, I think of the Philippines, there are a few others, who have built reserves, are still relatively poor, and don't have huge amounts of reserves. They're not in my hit list. I mentioned at the outset, we've identified 20, 25 countries that we view as currency manipulators in this aggressive and egregious sense. And I don't think any of the countries that you would probably put in your category are on my list. We ought to compare lists and check. But the ones that I have in mind have reserves that are way in excess of what's normally viewed as needed. The IMF rule is you should have reserves equal to 3 months of your imports. There's a much more conservative rule associated with Alan Greenspan that says you should have reserves 100% covering your short-term foreign currency liabilities. The countries I'm talking about massively exceed both those tests. So I would argue that it's the degree to which those policies have been carried in those countries that I'm identifying that create the problem. You may have an equal list of countries with lower levels of reserves where I would acknowledge self-insurance build-up, quite understandable.
So we've had 2 questions on the web, and then we'll wind up with you, and I thought we had a question there. Martin, go ahead. Martin wanted to know whether consumer choices can take care of some of the problem that you've identified, or must we have a multilateral solution? And Andres wants to know, if undervaluing currency is banned, what are the alternatives for creating the competitive conditions that developing countries need? So 2 questions on the web.
Yeah, those are good questions.
Can we take the 2 microphones and then we have...
Oh, sure.
We've got time for just one more round. Go ahead.
Yeah, thank you, especially the first speaker. Your ideas were brilliant. I remember when I was a punk kid when I argued against the Washington Consensus and was ridiculed. And if I was 1/10 as articulate expressing your ideas as you were, I probably wouldn't have been. So I thank you for that. But now for the other speaker, you're expressing basically what's the Washington Consensus. And all of those arguments have created a lot of pain in the first world, to the point where almost the first world in 20 years, if the trends continue, will be the third world, and the third world will be the first world, and they're not going to be as generous with foreign aid as we have been with wanting to raise the rest of the world to our standards. In fact, they're going to just enjoy it, and much like... And that's why I have a couple of questions. Why would China ever not continue to follow this way if they are allowed? They're getting richer. They've had 10% growth rates. They've created 300 million people into the middle class in a matter of 2 decades. They're going to usurp the U.S. as the most powerful, important country geopolitically. They're gaining an edge. The Middle Kingdom is going to see itself once more being the preeminent industrial, economic, and political power in the world. It has nothing to benefit, nothing to benefit to not abolish this policy. And as I'm sorry, sir, I'm kind of stammering, but as I've forgotten the first speaker's name, as you pointed out, much of the American and European oligarch and plutocratic class is suffering from Stockholm syndrome to the emerging Chinese Leviathan. That's one question. Now, your question about manufacturing, Ross, whether it's, and are they more efficient, or they're not more efficient, they're cheaper. And there's a huge difference, and this is a mistake that's commonly made. And the reason they're cheaper, along with the 25-cent wages, is because of currency manipulation. So let us not confuse being more efficient and effective with being cheaper. The third world. Yeah. And when you said comments about, well, it benefits the consumer because the goods are cheaper. No, it doesn't. For a variety of reasons, one of which is because the goods are cheaper, but at the same time, you have a push down on wages. We only have to see what's happening to Detroit, where the middle class, the average person 30 years ago, with one income, twice the number of kids, a dependent spouse, could feel fairly secure that he would have pay off his house, have a new car, have a solid pension by the time he retires if he works for a medium or big size company. And things were pretty good. Now, the average guy, I remember when I was a student paying my way through university and grad school, where I could pick up,
Could you get to the
30, there were a whole bunch. Now, the excessive savings in China providing cheap capital to the rest of the world, well, that capital would be provided anyway, but that capital would be provided from the savings and profits of the domestic companies in their domestic countries. You don't need to have it all centralized in China, so that benefit is out. And finally, the equilibrium exchange rate equations, same like Bretton, I don't think they're really necessary. It's done, the market will figure it out. If a country has a trade surplus, its currency is too low. If the country has a trade deficit, its currency is too high. You know, you can avoid all this mathematical creativity and just look at the fundamental of markets. And my last.
Actually, if you don't mind,
Okay,
we've got
sure.
people waiting. That's plenty. Concise questions, please.
Yes, I really enjoy the speech tonight. I have two questions. One, do you think that the global financial, economical situation is addicted to growth? Because probably first time in our lifetime, we might not see the growth in the global economy due to a number of factors. Population growth is one of them. So that's my first question. My second question is, in your introduction, was said that you can change somebody's life. So I want to take an opportunity and ask you which currency I should buy, which one I should sell.
Okay, that's concise. Last question from you, and then we'll come back to you, Fred.
All right, so I have a couple questions about your discussion of the financial crisis. I've usually heard of the currency manipulation in terms of China buying US bonds, but I was wondering if this was more widespread, if it was something in other areas of investment in the US economy that, that led to the availability of cheap money. As well, you talked about moral hazard and the lack of political will, but I was just wondering to what extent this was known at the time or prior to the crisis, and how much politicians would have had the opportunity to take this type of thing into consideration when crafting their policy. And as well, I was wondering what you think the prospects are for things like taxing the foreign investment in the U.S., how likely it is that those types of policies would be adopted.
And there's also someone asking something similar on the web, which is if manufacturers were less willing to offshore jobs, would currency manipulation be as effective? So a series of questions about consumer choice and corporate behavior in some ways.
Right. Well, a large number of questions, all very interesting, all very good. Let me take them, I think, in reverse order. The young lady on this side had some good questions. You asked if it was just government bonds that the foreign manipulators bought. No, they bought and do buy every day a wide variety of U.S. assets. They buy some equities, they buy some private corporate bonds, they deposit some money in U.S. banks. But the big buildup is by central banks around the world, monetary authorities. They tend to invest very conservatively with a high emphasis on liquidity. So most of their investments do come in U.S. government securities, including short-term Treasury notes, Treasury bills, and a little bit longer-term paper. But most of it goes into government securities, which is one reason that I suggested holds down the cost of borrowing to the government, encourages the government, our government, to run big deficits, even in periods of boom when it should be running surpluses, like before the crisis. Just a side footnote, the big U.S. budget problem is really that we went into the crisis with a lousy budget position. We had terrible boom management. Back when the economy was booming, we should have been running surpluses. And you may remember, as early as as recently as 2000, 2001, we were running budget surpluses. Only 10, 12 years ago, we were running budget surpluses. And then, horror of horrors, the thought was that, well, if we ran these big surpluses for too long, the government would have to start buying private stock and somehow the economy would become nationalized. It was a ridiculous theory. It led to the Bush tax cuts, approved by Alan Greenspan, and it put us on the road to huge budget deficits when the economy was booming, so that when we went into the crisis, when we needed then stimulus spending, we were in terrible shape. By contrast, China went into the crisis with a big budget surplus, and therefore had lots of maneuverability and lots of room. Full credit to them. They'd run their boom period economy very sensibly and prudently, and as a result, they didn't go off the tracks like we did. That's an aside, but the answer to the young lady is they buy mainly government bonds for the reasons I indicated. You extended the moral hazard question. You said, were the politicians aware of it at the time? Yes, they've been aware of it, but like everybody else, when times are good, they want to just let the ball keep rolling. Nobody wants to pull the punch bowl away. Ben Bernanke, interestingly, he was at the time a member of the board of governors of the Federal Reserve. He was not yet chairman. He gave a series of speeches back 2004, 2005 about a savings glut, and actually identified the problem pretty effectively. Alan Greenspan, who was chairman of the Fed, talked about the famous conundrum. He said, I'm trying to tighten interest rates. I've raised short-term interest rates, but long-term interest rates stay down. I can't figure out why. Well, the answer was all this foreign money pouring in as a result of the currency manipulation and foreign surpluses. I don't think he got it at the time. Bernanke, I think, did, and has subsequently continued to talk about it. Bernanke is a pretty, I won't say he supports everything I said tonight, but he supports a very large amount of it, and the basic thesis, I think, is one that he would agree. The gentleman over here, with all the comments, you basically endorsed what I said, so all I can do is thank you for supporting my approach. I will underline one thing you said. You said, well, why would the Chinese ever stop? It's worked. And that's why I'm saying there has to be an international reaction. That Michael is right that there are a lot of reasons why the Chinese should see it in their own interest to change, but you pointed out, as I did, a number of reasons why they kind of like what they've been doing. You could argue that it's worked. And unless they are forced to cease and desist, they're probably not going to do so. And that's why I'm calling for some tough new measures to do something about it. And again, why our Congress is beginning to do so as well, because the understanding is spreading that without some such reaction, they won't change. On all these questions about, somebody raised the question, I guess on the online question, okay, suppose we got them to stop manipulating, what would they do to strengthen their own economies? Well, that's a very important question. And the answer is they would stop relying on big trade surpluses and expand domestic demand. This has been agreed in principle by the G20 since it started meeting to deal with the crisis in 2008, that to get a sustainable world economy, there has to be a big rebalancing. You can't have the US running big deficits, China running big surpluses, Germany running big surpluses, Japan running big surplus. Not just the US and China, I use them as proxies. They're the biggest, but there are lots of people on both sides. But you can't have a sustainable world economy with big imbalances of that type, reflecting big internal imbalances, budget deficits of the type that the US has been running now for the last several years. So as the US has to reduce its trade deficit, export more, invest more, the Chinese, but the other manipulators have to stop relying on foreign markets and expand their domestic markets, which most of them are in good position to do. These are reasonably large countries. Asia as a group is a huge economy. They can export more to each other, but they have lots of opportunities to build domestic demand. Again, as Michael said earlier, the Chinese, in almost every public pronouncement, say that's what they intend to do. And I think one ray of hope in this whole process is that the new government Chinese, the Xi Jinping government, is beginning to show some signs of serious reform initiatives, not just words, but serious reform actions, which would shift the focus of their economic development strategy away from foreign markets into domestic markets. Per capita income is very low in China, as I said. Consumption is very low as a share of total national income. There's enormous scope for China in particular to shift away from relying on the export market to relying on the domestic market. So they've got plenty of alternative. They've enunciated a desire to go that way. What we need now is policy actions, of which a number are quite possible, for them to do it. So it's a good question, it's an important question, but I think there are very ready answers to that. On all these questions about consumer choice, the impact on the consumer, as I said before, any economic variable has two sides to it, and the positive side of the Chinese manipulation for the US or Canada or any importing country is the cheaper imports. But the theory of consumer choice and all the libertarian thinking that goes on around it, and the straight economics, which I, like practically every economist, believes in, market economics, consumer choice is normally thought of as responding to market prices. And the problem with the currency manipulation is that it distorts the market. In this case, it happens to distort the market in favor of the consumer because it cheapens the products from China or Malaysia or anywhere else that she or he can buy at the Walmart or some other store. But we don't normally think of that as a reflection of consumer sovereignty. That's the consumer being subsidized by somebody, which is fine for the consumer, but as I said before, has some very adverse effects on the other side of the equation. So if we're thinking in terms of consumer sovereignty, consumer choice as normally articulated by at least economic analysis and most political philosophy as well, it's consumers reacting to market prices, not distorted prices. That's why it has always seemed to me that the people that ought to agree with the thesis I was putting forth tonight ought to be the most conservative and almost reactionary economists and politicians. It ought to be the right-wingers because they are the ones who put the great emphasis on the market and responding to market forces and avoiding big government intervention in the market. That's what manipulation is. That's the government of these manipulating countries injecting themselves into the market, distorting market prices for a government purpose, violating all the principles of libertarians and free market economists and those who normally choose to be seen as conservatives on the economic spectrum. That's why it always puzzles me that the editorial pages of the Wall Street Journal, for example, excoriate responding to currency manipulation. They say, let the market do it, seemingly oblivious of the fact that these are the biggest market distortions, as I suggested before, probably in the history of mankind. When a government of the size and power of China, but Japan, Malaysia, Switzerland, any of the other countries that are on this list, when they inject their enormous resources into the market to distort prices, that ought to be public enemy number one to the conservatives. And so it ought to be they, on the right wing, so to speak, who would be leading the charge against these practices. It's always puzzled me they don't do it, but now, as I say, many Republicans in both our Senate and House of Representatives are very actively engaged in an effort to do something about it, and I think they, in some way, are the natural leaders of the process.
Thank you. Michael, do you want to comment on something?
Yeah, I guess I just wanted to respond a bit to some of your questions. I mean, I don't want my questions to be misinterpreted. I wasn't arguing particularly for anything other than to ask Fred the question, when you've had a system that has been in place like this for a period of time, to make changes, there are going to be winners and losers, I guess is one way of putting it. And arguably in the United States, consumers in the United States have had relatively low price goods, so there's an issue about changing that dynamic. There's people who have taken advantage of these savings from China. And I was really just asking the political economy question, I guess, in the United States about what is the political dynamic and how does that shape up in the United States? And I think Fred gave the answer that the US Congress now is seized with the importance of the manufacturing sector and jobs in manufacturing, and that is what is being the driving force now in the political economy of the United States. And I was simply trying to draw out that question. I guess or draw out some answers on that. I guess the second thing is, you know, Fred and I both believe in flexible exchange rates. He's proposing some very robust measures in the international system to enforce that. I guess you have to have yourself convinced that the outcome is going to be what you're looking for, though, in the United States. And I was just trying to probe, I think, Fred's views on that. The third point I think I was trying to make was, you know, if you are going to have a system of international rules, it's got to be based on something, and it's got to be based on measurement of certain kinds. And some of these things are very tricky, and you just have to have a great deal of confidence that if you're using some metric, that you have confidence in that metric if you're going to have a system of international rules that you're going to apply.
If I could just make one final comment. Michael rightly characterized my responses to him before, and it is a growing sense that the adverse effects on our economy outweigh the benefits, and therefore something's got to be done about it. There's one other element which is partly philosophical, partly political, that I should have mentioned, and that's simply the element of fairness. When we talk about international trade, it's supposed to be based on a series of pretty widely agreed rules. That's why we have a World Trade Organization. It's got a lot of rules. It's got a dispute settlement mechanism when somebody violates the rules to deal with. And that's why I said this currency manipulation issue is a huge gap in the international system, because there are prohibitions against it, but there's no enforcement of that. And so in our Congress and in wide parts of our society in the U.S., there is a sense of elemental unfairness that other countries, including some very big ones, are cheating, they're violating the rules, they haven't been called into court for it, but they're still viewed as being cheaters, and therefore creating an unlevel playing field, which is just not morally right, not philosophically acceptable, and therefore, at the end of the day, somebody's got to do something about it. And that's essentially where the debate is going now and where I think it's coming out. Michael is quite right to say that the fact that the practices have been going on for a while makes it more complicated to deal with them, because then they get built in and almost accepted as a part of the landscape. I think this problem should have been dealt with at least 5 years ago. The reason it wasn't, and actually pressure was building up in the U.S. to do something about it 5 years ago. But then what happened was the global crisis hit. And that, of course, swamped everything, and it reduced the imbalances, but it also just swamped everything else, and you had to put total emphasis on getting out of, or avoiding a global depression and getting out of your national recessions, and everything else paled by comparison, and rightly so. But now that we're hopefully out of that dire circumstance, you have to go back and deal with these things, which in the meanwhile have festered, gotten worse, created bigger costs, and become more entrenched, and therefore it is more difficult to deal with them. So there's some very unfortunate timing around this issue and the lack of responses to it. In a way, it's trying to play catch-up ball now to put the genie back in the bottle, and that does make it harder, but it doesn't make it any less important.
Well, thank you both. Thank you all for your comments. Thank you, Fred, for having, as you've been doing for several decades now, seeing an issue that no one else has and drawn our attention to it and stimulated discussion around it. And to use a very Canadian analogy, you're one of those that isn't where the puck is, but where the puck is going to be. And that's something you've been doing throughout your career. Thank you for that. Over to the other Fred.
Indeed. Thank you to all of our speakers. Thank you to Rohinton for moderating. A few quick notes before we adjourn. The video from this broadcast will be posted to the CIGI website, as well as a blog where you can add your comments and discuss the issue further if you'd like. Our next events in the CIGI auditorium take place on October 21st, when we screen the second movie in the free CIGI Cinema series. You just have to register online. We'll be showing the 2013 film Money for Nothing, Inside the Federal Reserve. On October 23rd, CIGI Senior Fellow Paul Bluestein will discuss his new book, hot off the press, called Off Balance: International Institutions and the Global Financial Crisis. And on October 24th, Mike Hulme from the Department of Geography at King's College London will present The Public Life of Climate Change, the First 25 Years. So be sure to register for those events and for our newsletter. And thanks again to CIGI's event sponsor, Wordsworth Books. And thank you all for coming tonight and participating. Have a safe journey home.